Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just after 12:20 and on November 15th, and we're joined by Angie Setzer. Angie is the Vice President of Grains for Citizens Elevator, and been trading and tracking the grains for over a decade. A lot of experience there and a lot of great insight. Angie's been joining us regularly to talk about the markets, and got a lot to talk about today. Angie, how are you doing?
Great. How are you?
Good. A lot going on to keep everybody busy, whether it's equities, fixed income, energy, ags, currencies. More recently, it's been the energy side. Right here, we're nat gas routine day. We're back below $4, but it is down 18%. Crazy moves.
Yeah, all over the place. We've been watching it. I've been watching it from the outside looking in more than anything.
On that, we were just started to talk about, ethanol has been kind of something that we haven't talked a whole lot about on the site, but, that's a key area for the energy market for a number of different reasons. And one being, what's going to happen? Is it going to be E10, E15, and how that affects things? But just in general, with all this volatility in crude and natural gas, how has it affected, what you're looking at and people you're talking to?
Well, it really has not been something that you would necessarily say we've been noticing, over the last few months. So obviously, you've seen crude and other energy costs or energy markets soar higher. Well, corn has kind of been stuck in the fundamental doldrum, or we haven't really seen a big move on the corn side of things that you would think you might see, if you compare it to 2006, 7, and 8. So if you look back at charts and kind of overlay crude and corn in 2006, 7, and 8, you'll notice that an up day in crude generally meant an up day in corn. It wasn't until probably beyond 2010 or so that we actually saw the two kind of divorce one another, and maybe it was even later than that. I'd have to go back through and look at several years, but this year in particular has been one where we've really noticed, as the crude market has rallied, that we had not seen that follow through purchasing and the corn side of things. Now, obviously, this year, the one thing that we have talked about in the past, or that has come up several different times, has been the refinery exemptions when it comes to blending, the lack of need for RINs. In the past, if you were a refiner and you were refusing to kind of put together the infrastructure needed to blend in ethanol into your gasoline before it was sold or sent into the marketplace, you then could purchase a RIN, a renewable identification number, that was basically created upon any time a gallon of ethanol was made. So you could buy a paper gallon of ethanol in theory, and that market structure had basically supported ethanol margins. So if corn prices were a little bit higher, and distillers prices perhaps were a little bit lower, you still had this desire from refiners to own these RINs, and this helped to kind of offset some of that loss that you may have seen via other grind margins. Now, it's been something of conversation, over the last 2 years. Actually, former EPA head Scott Pruitt was really good at giving out refinery exemptions, hardships exemptions. I couldn't put the exact number on how much those had increased with the start of that administration and his role there, but it had been pretty large. Even some of the bigger refiners who, you would be hard pressed to figure out how they were experiencing hardship when it came to blending in ethanol, were kind of gifted these refinery exemptions. So it's injured the RIN market in general, and really kind of pressured ethanol margins as a whole. Well, fast forward to this week, and we did see suddenly this kind of resurgence of a crude corn sort of relationship. When crude fell off on Monday or Tuesday, excuse me, as hard as it did, you did see corn fall off, quite a bit harder. And some folks will say it was because wheat had fallen off after a big trading day on Monday. But corn on Monday, when wheat was up 15, only wanted to be up a penny, whereas on Tuesday, corn was really eager to go 4 or 5 cents lower or so. So we are starting to see that relationship kind of come together again, but more so only in the sense that ethanol margins are already exceptionally poor. And if you see the price of gas and the price of crude fall off, in theory, that blend wall gets higher. So that's been the conversation of being able to break down the blending wall and creating our own market when it comes to ethanol, which is a high octane, relatively cheap fuel to blend into, and why we would like to see, year-round access to E15 and things of that nature. But there is, when ethanol is cheap enough, this desire, if gasoline prices are high, to blend in, additional supplies. You can get away with, 10, 12, 13% without causing, anyone really noticing. But if the price of gasoline obviously is cheap, then that desire to blend is not as necessary, and your blend wall, remains firmly in place. So it is something that we've been seeing. It's something that we've always been watching out of the corner of our eye. Obviously, natural gas and items like that go into ethanol production as well. And so if your costs go up and your product price is going down, it makes it even more difficult. And subsequently we've seen several plants change hands here recently. Another Green Plains plant was announced as shutting down permanently in Virginia. That was announced this morning. There's a plant in Iowa that's going back to half rate grind over the next 6 months. I mean, there are some hardships out there, and we're definitely seeing them kind of compounded with lower energy prices.
Sticking to the RIN world, I have a few friends that trade RINs. Where are I guess D18, I guess D6, like ethanol 2018 RINs?
Oh goodness, I would have to look and see. The last I knew, they were at the multi-month lows, and they hadn't really done
Yeah, I saw them
much.
trade down to like 12 or 13 cents. I haven't really checked in probably a month or
Yeah,
so. I wasn't
you and
sure
me
if
both.
I
It
wasn't sure if
was,
they were at a nickel or I have no idea. But I mean, that's been a market that's been crushed. And then I guess not necessarily knowing the price, but is that kind of what you're hearing as well? Kind of like with the EPA, are they looking at a way of almost like getting rid of the RIN, or
yeah.
almost just getting it to a price that it's almost regulated, like let's call it a nickel or something like that?
Well, that's been the conversation, and that's been the struggle that we've had. I mean, the administration kind of threw out this idea that, oh, hey, we'll allow RINs to be applied to exports or something of that nature, and so that's also been something that the biofuel industry has been against. Simply because it does kind of defeat the purpose of having them in play. And so, yeah, I mean, it is something that we're hearing, is that the administration is trying to kind of put this, olive branch, if you will, like, well, what if we do this for the petroleum industry? And from a whole, the petroleum industry really isn't, they're not a fan of ethanol in general, and so the last thing they're really going to do is trip all over themselves to come up with something that's going to benefit that industry. And so we did see the E15 announcement, but that for one is not an official. It's just we're going to try to move in that direction. And then for two, the API, the American Petroleum Institute, came out and automatically said that they're going to sue. Like, there's no way that you can require or push this 15% blend. So yeah, I mean, that's part of the struggle too, is it's that old Christmas story, Randy laid there like a slug, it was his only defense. And that's basically the RINs right now are just kind of laying there like slugs, because I mean, at this point, I've always tell my customers, unknowns favor the bear. So if you were in the RIN market and weren't necessarily one that had to buy, why would you at this point in time, just based on the fact that, for one, the current administration, hasn't necessarily been friendly to the idea of letting them trade freely. And yes, they did get out of hand. I mean, you saw it a year or two, probably 2 or 3 years ago now, where they just shot higher. You had a lot of speculative buying come in, and things of that nature kind of take over. And so there's been some times where, yeah, they have created hardships, but in theory, it should work itself out like any other, quote unquote free market would. And right now, there just seems to be too much government intervention in it to make anyone feel safe to trade it. But yeah, there have been plentiful conversations about, how do we fix this RIN market? And most of the oil producers out there just kind of continue to push the idea of um, maintaining these exemptions or not requiring folks to blend and things of that nature. They would prefer we just did away with the RFS as a whole, more so than anything.
Yeah. So with all the recent crude oil, the down move in the crude oil, I guess up move in natural gas, but really RBOB crude oil moving lower over the last 30 days, how, if at all, has that affected corn? I heard you reference it slightly last week. It might have had an effect, but has there been much an effect? And what's driving corn and wheat into year end here?
Yeah, it hasn't. I mean, it's more of a recent effect, I guess you could say. We did see the corn market try to trade much higher today, as well as the bean market. I just took a look at that. That took a big turn for the worst in the short time that we are talking. Last time I looked at it, we were up 9. Now we're up a penny. Really what's been impacting corn especially more than anything over the last week or so has been this. We saw this huge change in China stocks. So the USDA came out last week and agreed with the China National Statistics Bureau, who had updated their agricultural census numbers for the first time in a decade, and said, "Oh, we found these provinces that we weren't counting when it came to corn production." So they kind of lifted up the tablecloth, and underneath was like 6 billion bushels of corn. And the USDA said, well, we have to do it. So last week you saw the USDA basically double corn, global corn stocks. So I've been talking to you for the last 6 months, 7 months, 8 months, whatever it is. And I've been, kind of saying, well, the story in corn looks bullish. The story in corn looks bullish. But every time we turn around, the USDA comes out with a new piece of information that is far from bullish, and one that isn't necessarily something that you could have seen coming, a week prior or something like that. Like the one 80 yield, corn yield, and the higher corn stocks in September here in the U.S. And then, this China deal. So what they did in one foul swoop is basically doubled overall global corn stocks. Now, obviously, China's corn, for one, is exceptionally poor quality. For two, no one's really sure if it's even there. I made a comment, last week that they would have had almost 2 billion bushel of corn more than us at harvest this year. And for us in the U.S., you saw corn everywhere. You don't see that same thing in China. Now, obviously, their agricultural landscape is quite different. They have a lot more land mass and things like that. But I've never seen a picture of a Chinese grain bin. So it makes you wonder where they put 18 billion bushels of corn. But that's really been influencing corn more than anything. We had this pipe dream kind of develop, prior to this last report, that perhaps we would, if we were to see a resolution to the Chinese trade war, in my opinion, based on the old Chinese numbers, that would have been more bullish for corn, with China pushing towards the E20, E10, move by 2020. That obviously at this point in time doesn't look as though it will happen. So corn's kind of, it keeps, every time it gets itself up off the mat, it seems as though the USDA punches it in the mouth again. So we'll have to see what happens there. But
is there any sort of catalyst? It's amazing, actually, looking at the calendar. I think we only have like 27, 28, 29 days left in the trading days left in the year.
Yeah.
What's the catalyst, if any, in ags over the next, month and a half?
China, that's it. The Chinese trade solution. If we see a Chinese trade resolution take place, at the G20 summit, and suddenly we're best friends again, and we see China agree to take on a large portion of U.S. business or something of that nature, and actually see that business start to be conducted, that would be our catalyst. Other than that, I would say we're in full-blown holiday mode on our end. We might get some interest day to day, depending on what happens with outside markets, any sort of inflationary ideas, something of that nature. But to be completely honest, I don't think we'll see, much in the way of any sort of exciting trade, unless we were to see some sort of Chinese trade.
It's,
resolution.
the G20 that you're referring to, it's, I'm skeptical of, the initial headlines, whatever.
Oh
It's
yeah.
going to be, oh, we're best buddies, we're on the right path, and, markets might rally. It's going to affect the global markets, equities, fixed income, and, as you said, ags. But we'll see what the headlines are the next few days. Remember, it was like the president was just in France, and they're like, "Oh, everybody's buddy buddy." Then literally on the plane back, the president's tweeting negatively about him. Everybody's like,
Yeah.
"Oh, his hands on his knee. It must mean things are going really well over there."
Yeah, yeah. And that's, I mean, that's really where we're at right now, unfortunately. And that's part of what we saw here, with today's trade, is we came in this morning with this idea that we were going to, we were getting somewhere. China had responded in writing to the U.S. demands when it comes to trade, and we're actually getting something accomplished here, and obviously, you're buying the headlines and selling the facts, or the fact is that nothing much had changed really overnight, even if they had responded from what I had seen yet this morning. But there is some desire to push this market higher. Everyone seems to think that the trade war has been bearish soybeans, which is true, it has been. But a lot of folks could rationalize or say that even with um, even with the trade war and the idea that everything's exceptionally bearish, et cetera, a 955 million bushel carryout like we're looking at in soybeans, would basically rationalize a $2 drop in the market structure, and no one would really bat an eye based on the fact that current carryout structure looks to be the largest that we've really ever seen. Stocks use is a bit tighter, but carryout number at face value is the largest. So
What about,
yeah,
about
I
10
think,
days ago, there were some positive headlines supposedly, and soybeans had a big rally, and we've actually kind of held that rally. But my question is,
yeah.
if we were to get really positive developments out of the trade talks, where does soybeans go?
Well, I think they definitely push higher for a bit. I wouldn't be the least bit surprised to see a quick 25, 50 cent pop to the upside, just out of the overall excitement. I think long term, though, if we see a continuation of decent weather out of South America, I think we probably see, um, big crop long tail is what folks call it. So you tend to see these large numbers come in, and you think it's okay, well, we've seen the worst, and then you slowly just lose air as time moves ahead. And so I actually saw a conversation this morning on Twitter that I agreed with wholeheartedly from some other market analysts, saying that if anything right now, it would almost be the worst thing for the soybean market to see a correction, or a resolution in the China trade war, just simply because of the fact that it would likely cause a significant move higher in futures and encourage guys to plant again next year. So if you were to see November futures get another November 19 futures get a 50 to 75 cent pop, suddenly you're back up above $9 cash soybeans for a lot of farmers, for harvest delivery next year. And it's, they only remember the most recent number that they were able to put together. So then suddenly we don't get the correction in planted acres that we kind of need in order to ratchet down these surplus carryout numbers. I mean, it would be positive. You could see soybeans move higher, and it would be positive overall if we were to see a trade resolution combined with a South American production issue, combined with a huge increase in second half, or the next 3 quarters of the marketing year sort of time frame of demand from China. But there's a lot of things that at this point in time, if you were to really factor in what's going on from a fundamental standpoint, even with a trade resolution on the China side, you really shouldn't move much higher than where we are now, just purely based on fundamentals. The carryout number that we're looking at and things like that. I mean, we're looking at 9 times the pipeline minimum amount. So you're not just looking at surplus, you're not just looking at burdensome, you're basically choking on beans to a certain extent. And yes, China not being present in the market is a part of that, but you're looking at a 955 million bushel carryout. If China were present and taking in what they had purchased in the years past or something like that, we'd probably be looking at a 700 million, which is still stout. So even with a correction in that trade issue, you're still looking at historically large levels of production. Now, if the USDA comes out and surprises us and reduces yield significantly, and we see production drop off, more than expected or something, obviously that would be a different story. But at this point in time, I always tell my customers, you can only trade what you know. And obviously right now, what we know is that we have a lot of beans. Even with the resolution, with the China trade war, we're still going to have a lot of beans on hand, when we get to September 1st of 2019.
Right. All right. Well, Angie, I really appreciate you taking the time, giving us a lot of good information. I want to check in on the RINs as well.
Yeah,
That's a crazy market there. But thank you very much for joining us. A lot of great info, and we'll talk to you soon.
sounds great. Thanks for having